April 2026. Gold just crashed 8% in 72 hours. The dollar is surging to multi-year highs. And the Federal Reserve's latest inflation forecast confirms what institutional desks have been whispering for months. We are entering a structural inflation regime that will force the Fed into a policy trap not seen since Paul Volcker's era. While retail investors panic over headlines about the Strait of Hormuz blockade and Bitcoin's drop to $71,000, smart money is quietly repositioning. Because what looks like chaos to the uninformed is actually a textbook macro setup for those who understand the interplay between real rates, energy shocks, and dollar liquidity. Let me show you exactly what is happening beneath the surface. The narrative that gold should rally during geopolitical crises just died. On April 14th, Trump ordered a naval blockade of the Strait of Hormuz, a choke point responsible for 21% of global oil flows. Oil futures spiked 18% in Asian trading. Bitcoin, the so-called digital gold, dropped from $78,000 to $71,000 in 48 hours. And gold, the traditional safe haven, plummeted from $2,240 to $2,150 per ounce. This is not a bug. This is a feature of the new macro regime. Here is why. The Fed's April inflation forecast, released just 72 hours before the blockade announcement, showed core PCE inflation accelerating to 3.2%, well above the 2% target. The market immediately repriced the probability of rate cuts in 2026 from 75% down to 38%. When real rates rise, gold loses its appeal because it pays no yield. The dollar, on the other hand, becomes the ultimate safe haven because it offers both liquidity and positive real returns in a hawkish Fed environment. This is the exact same dynamic that played out in 1980 when Volcker crushed inflation by sending real rates into double digits. Gold peaked at $850 in January 1980, then collapsed 65% over the next 2 years as the dollar surged. Retail investors who chased gold into the top were annihilated. Institutional players who understood the Fed's commitment to fighting inflation made generational wealth by rotating into short-duration treasuries and dollar-denominated assets. Now let us cross-verify this thesis with two critical macro data points that confirm we are in a regime shift, not a temporary dislocation. First, the University of Michigan's April Consumer Inflation Expectation Survey just hit 4.8%, the highest reading since 1981. This is not a lagging indicator. This is forward-looking sentiment that tells the Fed one thing: inflation expectations are becoming unanchored. When that happens, central banks have no choice but to tighten until something breaks. Second, the Atlanta Fed's wage growth tracker for Q1 2026 came in at 5.3% year over year, accelerating for the third consecutive quarter. Wage growth above 4% in a 2% inflation target regime is incompatible with Fed easing. The labor market is still too tight. Services inflation, which is 60% driven by wages, remains sticky at 4.1%. This is why Bank of America's forecast of 2 rate cuts in 2026 is now a contrarian outlier. The bond market is pricing in 0 cuts. The futures market is pricing in a 22% chance of a rate hike by September. Smart money is not betting on dovish pivots anymore. They are positioning for a prolonged period of restrictive policy, and that changes everything for asset allocation. So how do you position for this macro regime as a retail investor with institutional-grade insight? Let me give you 3 tickers derived directly from the macro context we just analyzed. First, UUP, the Invesco DB US Dollar Index Bullish Fund. This ETF tracks the dollar against a basket of 6 major currencies. When the Fed stays hawkish while other central banks are forced to ease due to growth concerns, the dollar becomes the cleanest dirty shirt. UUP is up 6.2% year-to-date in 2026. And if real rates continue to rise, this trend has significant room to run. Second, TIP, the iShares TIPS bond ETF. Treasury inflation-protected securities are the only fixed income instrument that directly hedges against rising inflation while still offering positive real yields. In a regime where nominal bonds get crushed by inflation and equities face margin compression, TIPS offer asymmetric protection. Institutional allocators have increased TIPS exposure by 340 basis points in Q1 2026, according to the latest 13F filings. Third, XLE, the Energy Select Sector SPDR Fund. The Hormuz blockade is not a one-week headline. It is a structural supply shock that will keep energy prices elevated for quarters, not weeks. XLE gives you diversified exposure to integrated oil majors and refiners who benefit from both higher crude prices and widening crack spreads. Energy equities are one of the few sectors that can maintain pricing power in a stagflationary environment. These three tickers are not speculative bets. They are tactical positions aligned with the macro forces that are reshaping global capital flows in real time. Now let us zoom out and examine the historical precedent that makes this moment so critical. In 1979, the Iranian Revolution disrupted oil supplies and sent crude prices from $15 to $39 per barrel in 12 months. The Fed, under Chairman G. William Miller, initially tried to accommodate the shock by keeping rates low. Inflation exploded to 13.5% by 1980. Paul Volcker took over in August 1979 and immediately pivoted to a war on inflation, raising the Fed funds rate to 20% by June 1981. The result, a brutal double-dip recession, but inflation was crushed from 13.5% to 3.2% by 1983. Gold, which had surged to $850 on inflation fears, collapsed to $300 by 1982 as real rates went positive. The dollar surged 50% on a trade-weighted basis. Retail investors who bought gold at the top lost 65% of their capital. Institutional investors who understood the Fed's commitment to price stability rotated into treasuries and made 40% returns as yields fell from 15% to 10% during the disinflation phase. Fast forward to April 2026. We have an energy shock from the Hormuz blockade. We have inflation expectations unanchored at 4.8%. We have a Fed that just signaled it will prioritize price stability over growth. The setup is eerily similar to 1979 to 1982, but with one critical difference: the Fed learned from Volcker's playbook. They will not wait for inflation to hit double digits before acting. They are front-running the shock by keeping policy restrictive, which is why gold is falling and the dollar is surging despite geopolitical chaos. History does not repeat, but it rhymes. And right now, it is rhyming in a way that separates those who study institutional playbooks from those who react to headlines. The next 6 months will define portfolio performance for the next decade. The Fed's inflation trap is not a theoretical risk anymore. It is the dominant macro force reshaping every asset class. Gold's collapse is not a buying opportunity until real rates peak. The dollar's surge is not a short-term trade. It is a multi-quarter trend. And energy equities are not a speculative play. They are a structural hedge against the supply shock that central banks cannot print their way out of. This is not financial advice. This is not a recommendation to buy or sell any security. This is institutional-grade macro analysis designed to give you the same framework that professional allocators use to navigate regime shifts. Do your own research. Consult a licensed financial advisor. And understand that all investment decisions carry risk, especially in environments where the rules of the game are being rewritten in real time.